When you buy a condominium, the insurance you need looks a little different than what you get for a traditional single-family home. For many buyers, this is where confusion starts because you're not just insuring your unit. You're also relying on the insurance policy your association carries for the entire community. So both policies work together, and knowing where one policy stops and the other begins is the key to protecting yourself, satisfying your lender, and avoiding expensive surprises down the road. So in this video, we're going to break down how condo insurance works, what an HO6 policy covers, how the association's master policy fits into it, and what you need to know before you close on your condo. When you buy a home, you insure the whole structure. When you buy a condo, you're only responsible for part of the structure or the interior of your specific unit. Everything outside your walls is typically insured by the association through a master policy paid for by your HOA dues. But here's the nuance that matters. Not all master policies cover the same things. Some associations cover almost everything inside the unit, while others cover only the building structure and nothing inside your walls. Because of that, your personal policy, the HO6, fills the gaps. So condo insurance is designed to work hand in hand with the association's policy. So you insure the part that you own, the association insures the part that everyone shares. That's the basic idea. Now let's get into the details. Your association has a master policy, and this policy always covers the building structure, the roof, shared hallways, elevators, parking structures, community amenities, and liability for common areas. But what it covers inside the units depends on the type of master policy that the community has. There are 3 common structures used across the United States. Number 1 is bare walls or walls out coverage. This is the most limited type of coverage. The association essentially insures the structure, the studs, the framing, the subfloor, exterior walls and roofs, and shared building elements. The unit owner is responsible for drywall, flooring, cabinets, countertops, appliances, fixtures, the paint, trim, doors, and any interior finishes. So if your community uses a bare walls policy, your HO6 policy must cover all the interior finishes, everything from the drywall inward. This is common in many newer condo developments because it lowers HOA premiums. Second type is single entity or all-in, original spec coverage. So here's the association covering all the original interior finishes, the cabinets, flooring, fixtures, but only as originally installed, and the building structure and common areas. You, the owner, are responsible for improvements, upgrades, betterments made by you or any previous owner. So if your original unit had laminate countertops, but someone upgraded to quartz, the HO6 needs to ensure the cost of replacing the upgraded materials, not the cheaper original ones. And the last one is an all-in or all-inclusive coverage. This is the most comprehensive. In this scenario, the association covers the building, the structure, common areas, all interior finishes, fixtures and improvements, built-ins, flooring, cabinets, appliances, whereas you primarily insure your personal belongings, liability, and additional living expenses and any kind of loss assessment. So even with an all-in policy, some owners still choose an HO6 for added protection because the master policy deductibles can be extremely high. An HO6 is not just a walls-in coverage, it's a package of protection that typically includes dwelling and interior structure coverage. So that covers the interior of your unit based on what the master policy does not cover. That could include things like drywall and paint, flooring, cabinets and countertops, interior doors and trim, built-in, appliances depending on the association's documents, and any upgrades and improvements. The amount you need depends entirely on the master insurance policy. That's why lenders ask to review the condo's master insurance certificate before approving your HO6 policy. Another type is personal property coverage. It covers your belongings like your furniture, your clothes, your electronics, your valuables within limits. So high value items like gold and jewelry, art, or collections often require a separate endorsement to be fully covered. It'll cover personal liability coverage. So if someone is injured inside your unit and you are responsible, liability coverage helps protect you from claims or lawsuits. This does not cover injuries in common areas. That's the association's responsibility. Another thing that's included is loss of use or additional living expenses. So if your condo becomes unlivable after a covered loss, maybe a fire or a pipe break in the building, this helps pay for temporary housing, meals, other necessary living expenses. This can be crucial in condo buildings where damage from one unit can impact multiple units. It also includes loss assessment coverage. This is one of the most important but overlooked pieces. So if the association experiences a loss like storm damage or roof issues or major repairs, and their insurance doesn't cover everything, the HOA can issue a special assessment to all owners. Loss assessment coverage helps you pay your portion of that assessment if the cause of the loss is something your HO6 covers, like fire, wind, or other named perils. So given rising master policy deductibles nationwide, loss assessment coverage is becoming a must-have. Here's where lending guidelines come in. Before closing, your lender will review the association's insurance certificate, check whether the master insurance policy meets the requirement for the loan program, so whether it's conventional, FHA, VA, etc. So determine what you need to insure, and if the master policy doesn't cover the interior of your unit, the lender will require an HO6 policy. So verify adequate replacement coverage. So your HO6 must provide enough coverage to restore your unit's interior to its previous condition after a covered loss. This protects both you and the lender's interest in the property. It's also why you can't assume all condos require the same coverage. It depends entirely on the master policy. Your condo's governing documents, often called CC and Rs, covenants, conditions, and restrictions, or bylaws, spell out exactly where the association coverage ends and yours begins. These documents determine what counts as your unit, what counts as common interest property, whether upgrades are your responsibility, what's covered under the master policy, what deductibles you might share with other owners. So every association is different and state laws will vary. So the only way to know your responsibility is to read the governing documents or talk with the property manager or association president. Like any insurance, HO6 policies have exclusions. Typically, they do not cover flood damage, earth movement like earthquakes, sinkholes, landslides, wear and tear, maintenance issues, mold caused by long-term leaks, and damage to community property. So if you're in a flood zone or an earthquake-prone area, you may need separate policies. Let's go over some examples. So in example one, this is a bare walls community. So your building has a fire, the association repairs the structure but stops at the drywall. Your HO6 policy would pay for cabinets, flooring, paint, trim, fixtures. So if you didn't have a sufficient HO6 policy, you'd have to pay for the entire rebuild inside of your own unit. Example two, the master policy has a high deductible. So let's say your building's roof is damaged in a storm. The master policy covers it, but the association has a $50,000 deductible. That deductible is shared among the unit owners. So loss assessment coverage on your HO6 policy will help pay for your portion. In example three, let's talk about some upgrades and improvements. So let's say your unit originally had basic materials, but a previous owner installed some luxury finishes, and a pipe breaks and damages the kitchen. The association covers replacement of the original spec. Your HO6 policy would need to cover the upgraded materials. Across the US, condos association have seen higher premiums, higher deductibles, rising building repair costs, and increased claims from aging buildings. These factors impact both master policies and HO6 policies. Owners should expect premiums to be higher than they were several years ago. For condo buyers, the goal is simple. You want to know that if something happens, you're protected and you're meeting your lender's requirements. The right combination of a master policy, a correctly written HO6 policy, and an understanding of your association documents ensures that you're not left responsible for damage you didn't expect or costs you weren't prepared for. Whether you're a first-time condo buyer or someone looking to refinance, understanding how these two policies fit together can save you money, frustration, and major financial risk. If you're considering buying a condo or you already own one and want to make sure you're properly covered, take a look at your HOA's governing documents and their insurance certificate. The more you understand what the association covers, the easier it is to set up the right protection for yourself. And if you want more clear, reliable explanations on homeownership, lending, insurance, and the systems that affect your financial life, make sure to hit that subscribe button. My goal is to give you accurate information so you can use it to make confident, informed decisions and win with Wade.